Happy Turnaround Tuesday, Moon Platoon. I hope you guys had a very nice day considering the stock is up, and we are now going to pay attention to the fact that Bitcoin and other cryptos crashing is going to cause more margin calls. MicroStrategy already falls 24% as Bitcoin inches underneath 21,000. That is the margin call squeeze that we have been keeping track of, because my name is Andrew. I'm a data scientist here in Silicon Valley. That is Professor Meatball, and we are going to tell you not only about the data you guys should already be paying attention to, but about today's topic, law of unintended consequences, which will help you guys understand a little bit better about how the manipulation is happening and exactly how ETFs are going to be the biggest piece of the puzzle in the near future. So make sure that you guys have already slapped that like button nice and heavy, because the Moon Platoon needs to be spread through that YouTube atmosphere. Destroying that algorithm is the first step, and making sure that you guys have already commented out which like you guys are is the second. So let's go. A simple system tries to regulate a complex system. See, that's the financial system that you guys are currently living in. So the story of ETFs, long overdue regulation and reg show time machine, the little product that has grown into a $1 trillion market, was created just after the great financial crisis and largely unaffected by the implications of a regulation SHO, as ETFs have the liquidity provision embedded in them using creation redemption in the secondary market. So these three, BlackRock, Vanguard, and State Street, these funds are generally seen as passive investing funds, and as long as the fund maintains its market cap weight, the underlying securities weights and share counts change often. One overarching theme is almost all ETFs have to contain at least 1 to 2 highly liquidity stocks, such as ExxonMobil or Apple, that due to its liquidity provisions is not affected by the deviations in the ETF net asset value and resulting arbitrage. So it is well known that big three are very deep in the share lending business, as the fee collection between ETF sponsors and short hedge fund creates a steady stream of revenue for them. So let's take a look at the collective ETFs by issuer over time. Red line is the open put, as the put open interest. Yellow line is the call open interest. Blue line with red dots is the GME percentage price change. All right, as proxy for our two stocks running very similarly according to each other. So there it is. Vanguard funds without VTI, so we have VT, ESG, V, VCR, etc. down here. Not that all funds trade options, right? And State Street funds down here. And we finally have a clearer connection in between where those peaks and values are. So who are these market makers? With ETFs, there are many authorized participants, APs, that facilitate trading on any one ETF, some more than others depending on size and who the issuer is. Please see the below in the broad market share depiction of APs in the ETF space. Okay. This is the FI ETFs versus the equity ETFs, about 600 billion compared to about 3.3 trillion. And there's a percentage of here. There's a little color-coded map there. Okay, so who are the GME ETF market makers? First, this data would not have been possible without a complete wizard with user Camposaurus Rex, who parts through each and every subcategory of ETF and ETF Trust series to pull off the creation redemption size data to map it out specifically for ETFs that hold GME. In keeping with the big three theme, we can all look at the market maker on the collection of funds by the specific issuer. The three largest APs are Merrill Lynch, Goldman Sachs, and Citadel. So there it is. Vanguard authorized participants here are Virtu, JP Morgan, and Citigroup. And finally, State Street, Merrill Lynch, Virtu, and Citadel once again. So what does arbitrage mean? In the case that the share price of an ETF exceeds the net asset value, NAV, of the fund, a trader could purchase the securities that make up the index the ETF tracks. At the same time, that trader could also sell short the ETF share. This action would lower the ETF price and raise the NAV, pushing the two prices back into alignment. At the close of the business, the trader would then redeem the basket of the security with the ETF sponsor, and they would issue a new ETF share. In the case there would be a creation of an additional ETF share, this process can work in the reverse, however, as the ETF sponsor would destroy an ETF share in order to return the trader a basket of securities used as to represent the index tracked by the ETF. For the ETF sponsor, who takes a small fee for redeeming shares, this is a zero-sum game. There are also two important facts about this process. First, there is only those deemed with AP, authorized participant, could redeem shares with the ETF sponsor. APs are usually large market making firms. Second, these transactions typically involve minimum of number of units to be redeemed at one time. For most ETFs, this number is 50,000 units. With the possibility that ETF funds are being rebalanced throughout the day and these redemptions are being done in large numbers, it is likely that ETFs can have some impact on the market as a whole. So there is a clearer picture of what we just described there. You have T0, T equals 2, T equals 1, and then T equals 2, and then finally long term. And an NAV-based order process and resulting creation of ETF shares here. So this chart lays out an NAV-based process and resulting creation of ETF shares here. The investor places an NAV-based order with the AP before the cutoff at the trading day T, and then the AP then buys the basket of underlying shares in the market based on the size of the original order and starts the creation process to transfer the basket to the ETF in return for shares. The exact exchange ratio is determined by the NAV by the end of the trading day T. Once the AP receives the ETF shares at T plus X, commonly known as T plus 1 or T plus 2, depending on the settlement cycle, they are forwarded to the investor at NAV. In order for an arbitrage trader to profit from the redemption trade, the spread between the ETF price and its NAV must be large enough to cover the cost of executing the trades involved. These costs included, but not limited to, the transaction costs execute the trade and the small redemption fee charged by the ETF sponsor. In order for such redemptions to take place, a large number of shares of the basket stocks must be bought and sold in order to complete the arbitrage process. As expected, larger spreads are immediately followed by increased volatility, if only for a short time. This increase in volatility is then presumed to be the effect of arbitrage traders making large and fast trades to take advantage of the mispricing of the ETFs. So another way the large institutions take advantage of ETFs is through wash sales, referred to as the market heartbeat. So you guys see a very similar heartbeat-like pattern here. And of course, everyone's favorite ETF, some securities that have more shares owned by institutional 13F filers than were issued, plus short interest. The continual rolling of a vertical put spread, right? This is the original January sneeze, the gamma squeeze here. And finally, XRT to boot, something that we've been tracking for a long time. So what is the full ape explanation? If you've had trouble following, good thing you came all the way to the very end of this video, because we're about to talk about that margin call that just happened because of BTC, but we want to finish this off with the final explanation. As you can see, when there's put interest drops an estimated minus 20%, we see a move of dramatic price in GameStop, which is using as a proxy for meme stocks here. We see a massive buildup in FTDs on XRT like we did in December, sending the ETF into Reg Show threshold list. But how does the mechanism work? Market makers are exposed as the expiring puts are repositioned and rolled into the next expiration, so for a brief time they are unhedged and must use the direct lending pool to borrow stock. So we get excited and suppress the price within reason. The put position is reestablished and market makers now have to go out into the market and buy what shares are available. So now with that understanding, let's take a closer look at that margin call squeeze. Today, MicroStrategy may have to post additional collateral for a Bitcoin-backed loan as the price of the world's largest cryptocurrency tests a key price level of 21K USD flagged by the company. The software firm controlled by Bitcoin advocate Michael Saylor said that they used the vast Bitcoin holdings to secure a $205 million loan in March to buy even more crypto. But as the value of that collateral initially was around $820 million falls to about half of that, the company may need to provide more capital to back the loan, which is exactly a margin call. Enough hedge funds margin call together, and that is the margin call squeeze. MicroStrategy has been closely linked with Bitcoin after it was one of the first major companies to buy the tokens for its corporate treasury, effectively making it a stock, a proxy for the cryptocurrency. Saylor, the company's chief executive officer, frequently touts crypto on social media and at conferences, including a tweet on Monday amid the sell-off saying, in #Bitcoin we trust. But the firm's bet in the token has backfired as of late, with paper losses on the firm's digital holdings approaching $1 billion after it paid nearly $4 billion to amass about 130,000 Bitcoins over the last 2 years, according to a company filing. If this hedge fund needs cash, they're going to have to take it from somewhere else. And more selling means more margin calls, and that's that domino effect already in progress. If you guys want to look at a video about how that the greatest wealth transfer that you guys have probably seen in your lifetimes is already in effect, that's that previous video. And if you guys haven't yet hit that subscribe button, I hope you guys have found some interest in some education, or at least it was fun to reach this part of the video. So if you guys wouldn't mind subscribing, hitting that alert button, making sure that you guys are keeping up and staying up to date with that data that could make you guys a good amount of chunk change in a good amount of time. So I'll see you guys in the money. Thank you to those of you who have already supported this channel, because you guys press that join button next to the subscribe button, or you guys went up to Patreon, either of which puts you on this end screen. So thank you guys, and we'll see all of you in the money. Peace.